Welcome back to Buck Wild Wealth. This time, we're getting into earnings reports,
Yeah.
but not just, the numbers themselves, but like what they actually mean for us as investors.
Exactly.
Because I think, a lot of times those reports, they just seem kind of like a foreign language. You know what I mean?
Yeah, yeah. It can be tough to decipher.
Yeah. So we're going to try to crack the code today with this research paper we found. How do earnings numbers relate to stock returns? Expert speaker, are you ready to be our financial decoder today?
Absolutely. Like you said, it can be a beast of a paper, but some pure gold in here for investors who really want to understand what's going on.
Okay, all right, I'm intrigued. Lay it on me. So you're saying it's not just about like how much money a company made last quarter. There's more to it.
Right. Yeah. It really comes down to how well earnings predict the future,
Okay.
or sometimes how they don't. Perhaps more importantly,
Mhm.
the paper calls this idea earnings persistence. So you can think about it like, the difference between a one-hit wonder band and then a band that just cranks out hit after hit. Which one do you think the market would reward more?
Oh, definitely the one that's consistently putting out, the hits. Right. So we're looking for consistency. That makes sense.
Exactly. Yeah. Consistency is key. And in fact, the researchers here found that companies with steadily increasing earnings, those consistent performers, they outperform companies with declining earnings by an incredible 35% in annual returns.
Wait, 35%?
35%.
That's not just a little bit better, that's like a whole different ballpark. So
Yeah.
just knowing whether a company is kind of on that upward swing or if they're, heading downhill, that's huge.
Absolutely. And what's even crazier is they actually compared their findings to similar research from a few decades ago, and the impact of earnings changes is even bigger now than it was back then.
Oh, wow.
So the market is placing more and more weight on these earnings trends.
Okay, so this is obviously important stuff, but how do we as investors, how do we figure out if a company's earnings growth is, the real deal? How do we separate the true contenders from those one-hit wonders?
Yeah, and that is the million-dollar question. That's what it all comes down to, and that's where the paper's breakdown of these three links comes in.
3 links, okay?
Yeah, think of it like a chain reaction.
Okay,
So first, obviously, a company reports its earnings,
right.
right?
That's the news we always hear. Yeah.
Exactly. But then, and this is key, those current earnings, they start to feed into expectations about future earnings.
Okay.
So if a company, consistently beats expectations, investors naturally, they're going to start to bake those higher earnings into their predictions going forward.
Right. So it's like if a company keeps exceeding those expectations, investors might think, okay, maybe they've figured out some sort of, secret sauce here. Maybe their growth really is sustainable.
Exactly. And that then leads us to the second link in the chain, which is how those future earnings expectations, they start to influence what investors anticipate in terms of dividends.
Right. Because more earnings, you would assume, would generally mean more potential money to distribute to shareholders through dividends.
Precisely. And then that brings us to the third link, and maybe the most important link in the chain, is that a stock's price, you can really think of it as basically the sum of all those potential future dividends,
Oh, great.
all bundled up into, the price of that single share.
So like a domino effect,
Yeah.
earnings influence those expectations, which then drive those dividend predictions. And ultimately, that's what determines, what the market thinks a stock is actually worth.
Exactly. Yeah.
Okay. And so this chain reaction just makes this whole idea of earnings persistence even more interesting.
Yeah, it does. And, an important thing to remember is this paper isn't just theoretical. They actually have the data to back this up. So, for example, they specifically looked at the impact of cash flow. So, the actual money coming in and out of a company.
Right. Yeah.
And as you might expect, positive cash flow, it was definitely linked to better returns, which makes sense.
Right, because you want a company that's actually making money, not just, playing games with the accounting.
Exactly. Exactly. But here's where it gets really interesting, is that the connection between that cash flow and returns, it actually wasn't nearly as strong as it was with earnings.
Wait, so you're saying cash flow, it's not king after all. Why is that?
Well, because earnings, while maybe a little bit more complex to grasp than simple cash flow, it actually gives you a much more complete picture of how a company is really performing.
It's kind of like, you have like a 5-minute conversation with somebody versus like a year-long relationship.
Right.
Cash flow is that like quick snapshot But earnings tell you so much more of the story.
Exactly, exactly. Yeah, earnings, they factor in things like, asset depreciation, for example, which cash flow alone it doesn't capture that.
Okay, can you maybe give an example? Because I always have a little trouble wrapping my head around depreciation.
Yeah, sure, sure. Um, Imagine you buy like a delivery truck for your business, right? So cash flow, it notes that big outflow of cash when you first buy it, obviously.
Right.
But then that truck's value, it slowly declines over time as you use it,
All
right?
right.
It's depreciation. And earnings, they actually factor that in, which, gives you a much more, I'd say, realistic view of your business's, financial health in the long run.
Okay, yeah, that makes sense. So we're looking for companies with those strong earnings and hopefully earnings that are persistent, like we were talking about. But how can we really tell if an earnings jump is like the start of something really big or just kind of a temporary blip?
Right, right. Well, that is the million-dollar question, isn't it? And it all goes back to this earnings persistence idea.
Okay.
The researchers found that when companies showed signs of high earnings persistence, meaning those increases, they seemed likely to actually stick around for a while. Investors
Hmm.
got really excited. They were driving returns significantly higher in those cases, but for like the temporary increases, the ones that didn't look so persistent, not so much.
So it's like the difference between a company getting, I don't know, like a one-time government subsidy versus like developing some game-changing new technology.
Exactly.
One's just a blip. The other one could, totally change the game for years to come.
You got it. You got it. And this actually leads to another fascinating little tidbit from the research, which is that the market actually tries to predict these earnings announcements before they even happen. Have you ever noticed how, like, stock prices sometimes jump up or down before the actual news comes out?
Oh, yeah, all the time. Yeah, it's like the market has a sixth sense or something. But but how accurate are those predictions? I mean, really?
Well, it turns out, on average, they're actually pretty darn accurate.
Wow.
Yeah, I mean, the market's processing a ton of information all the time, right? So you've got uh, economic data, industry trends, even just kind of whispers about a company's
I
performance.
see. Yeah.
All that's getting factored in. But, and this is where it gets really interesting, even after the earnings announcement is released, there's often what's called a drift in the stock price.
Drift. What do you mean? Like it keeps moving even after the news is out? Like
Exactly.
people still can't make up their minds or something?
Right, yeah, kind of. Let's say a company, they absolutely crush their earnings forecast, right?
Yeah.
The stock price, it might jump up initially, but then it often keeps rising, for weeks or even months after that initial announcement.
Wow.
And that's the drift. It's like the market taking a while to fully digest the news,
Mm.
figure out what it really means.
Okay, so then if a company misses its earnings, I'm assuming that drift kind of goes in the other direction.
You got it. Yep. The price might continue to drift downwards as the market absorbs maybe the disappointing news.
Right.
And this whole idea of post-earnings announcement drift, you know what it suggests to me? It suggests that the market doesn't always get it right, at least not right away. Like it doesn't immediately perfectly price in all of the information that's in that earnings report.
So you're saying even with, all the analysts and the algorithms and all the experts out there, there's still an opportunity for, for us individual investors who are paying attention. Maybe we can find those hidden gems or the red flags if we know where to look.
Absolutely. And this is where things get really interesting for individual investors. Understanding those nuances of earnings persistence, spotting those subtle clues that the market might be missing, that's how you gain a real edge.
So it's like the market's trying to put together this puzzle, but they don't have all the pieces yet. And we as investors, like we can find those missing pieces if we're digging in and we're paying attention.
Exactly. And that's the name of the game, right? Don't just look at those raw numbers. Really try to think about, okay, earnings persistence. Like, is this growth actually sustainable? What's the company's overall strategy? Are they innovating? Are they adapting to, the changing market? And then maybe most importantly, what is the market overlooking? Are there hidden opportunities here? Are there risks that maybe people haven't fully factored in yet?
So it's not even just about reading the earnings report. It's about reading between the lines,
Mm-hmm.
right? Understanding the company's story, what their potential is, and how all of that translates into, potential future value.
You got it. Think of it this way. When you buy a stock, you're buying a piece of that company's future.
That's true. Yeah.
And these earnings reports, they're a glimpse into that future, but you got to be able to separate, the signal from the noise.
I like that. Separate the signal from the noise.
Yeah.
That is some powerful advice. And I think that's it's a perfect note to kind of wrap things up on. So we learned today that earnings reports, they're not just these boring numbers on a page, right? They're narratives. They're stories about a company's past, their present, and most importantly, their potential. And by understanding those stories, by learning how to analyze those earnings trends, by spotting those whispers of persistence, that's how we can all make smarter, more informed investment decisions.
Couldn't have said it better myself. It's about going beyond those headlines, digging into the details, and developing that investor's edge that we've been talking about.
Love it. And for those of you who are ready to start your own deep dive into earnings reports, you can find a link to the research paper we discussed in the show notes. Until next time, happy investing.